If you've been on Twitter, you already know what's been unfolding. Silver has officially broken the 90 to 95 support range that we highlighted earlier. And just as we explained, once that zone failed, it opened the path toward our next downside target at 86. Price did reach that level, but it didn't T-stop there. As I'm recording this right now, silver is trading near 78. So why has the selling continued? The answer lies in a major policy development. President Trump has just nominated Kevin Worsh as the next Federal Reserve Chairman, not Judy Shelton, and that distinction matters a lot. Kevin Worsh is someone who has openly called quantitative easing a reverse Robin Hood policy. He supports interest rate cuts paired with balance sheet reduction, not unlimited liquidity injections. That is exactly the scenario we warned about in our previous video. We were very clear. If Judy Shelton, a vocal advocate of sound money, was not chosen, silver prices could fall below 86. That is exactly what played out. Markets are now pricing in a Fed chair who may be aggressive on tightening the balance sheet. And silver prices are reflecting that shift in expectations. Right now, markets are in full panic mode. Gold, silver, and Bitcoin have all sold off sharply. The dollar surged higher. And this isn't random chaos. This is a coordinated policy shift away from endless money printing. For the first time in years, paper markets are being forced to confront that reality. Quick reminder, if you're not following me on X, you're missing real-time charts and data I can't share here. My handle is OGJohnAG on both X and YouTube. It's verified, cannot be duplicated, so ignore the fakes. I don't sell anything, no courses, no signals, just unbiased information to help you think independently. Your feedback matters. Drop a comment telling me where you are watching from and where you think price goes next week. I read them and will address your questions. Now, before we move forward, I want to speak to two different groups watching this right now. Some of you are long-term physical stackers. You're seeing this dip, and honestly, you're enjoying it. You are probably in the comments already saying you ready to buy more, maybe even sitting back with popcorn watching the volatility. Your time horizon isn't daily. It's weekly, monthly, even yearly. To you, this price action is just noise, a temporary discount on real money. You're stacking metal regardless of short-term paper games. And this entire move only reinforces your strategy. Buy physical, accumulate on weakness, ignore the paper price theatrics. But others watching are short-term traders. You care about technical levels because you're actively managing positions, entries, exits, leverage, and stop losses. For you, daily price movement matters. The technical roadmap I am laying out is meant to help you navigate this volatility without getting wiped out. Both strategies are valid, as long as you know which one you're playing. So let OS connect what I laid out in the last video with what is happening now. I clearly identified the 150-hour EMA as initial support. Price respected it at first, bouncing nearly 10%, but selling pressure eventually broke that EMA, opening the door to the 90 to 95 support zone. I said if that zone failed, 86 or lower was next. That level broke. We tagged 86, and now we're trading at 78. The roadmap unfolded exactly as described. I also laid out two possible outcomes regarding the Fed chair decision. I said if Trump chose Judy Shelton, gold and silver could experience one of the strongest intraday reversals in history because her views on sound money would threaten the entire paper manipulation system. But if Trump went another direction, the battle would continue, and we'd likely hit 86 or lower. Trump chose Kevin Worsh, not Judy Shelton, and the no Shelton scenario played out precisely. We hit 86 and then fell further to 78. Both the technical breakdown and the policy outcome converged exactly as outlined. Kevin Worsh isn't a new figure. He served on the Federal Reserve Board from 2006 to 2011 and was involved during the 2008 financial crisis. Since leaving the Fed, he's been one of the loudest critics of post-crisis monetary policy. He has repeatedly argued that QE inflated asset prices, worsened inequality, and primarily benefited financial markets instead of the real economy. He's called QE a reverse Robin Hood policy. He also said the inflation surge after 2020 was a policy failure, not an unavoidable event. Here's the critical distinction. While Worsh supports lowering interest rates, his framework is fundamentally different from what markets have grown accustomed to. He advocates rate cuts paired with balance sheet reduction, not open-ended liquidity expansion. That's a huge issue. Markets are now grappling with the idea that rates could fall while liquidity does not expand the way it has in past cycles. That environment is hostile to leveraged positions, inflated equity valuations, and liquidity-driven rallies. In simple terms, Trump wants lower rates. Worsh wants discipline on the balance sheet. Markets are afraid of rate cuts without QE. The era of guaranteed QE is no longer assured, and markets are finally starting to price that in. Yesterday's sell-off accelerated the moment probabilities surged that Kevin Worsh would become the next Fed chair. Gold dropped, silver dropped, Bitcoin dropped. At the same time, the dollar spiked higher. This wasn't a technical coincidence, this was policy-driven. The market reacted to a tightening liquidity outlook, not chart patterns. Now let's shift focus to the physical market, because this is where the real story is unfolding. While paper prices are getting crushed, Shanghai spot silver is currently trading at 122.45 per troy ounce. Meanwhile, Comex silver is sitting near $78. That puts the Shanghai premium at over 44 per ounce, a 56.83% premium over Western paper prices. Let that sink in. Physical silver in Shanghai is trading almost 60% higher than Comex. Earlier, when Comex was at $86, the premium was already above $30. Now Comex has fallen another $8, but Shanghai prices have held firm near $122. As a result, the premium expanded to $44. Why does this matter? Because this isn't a momentum trade. It's a war of exhaustion. China doesn't need silver prices to explode overnight. It doesn't want panic. It doesn't want a sudden reset or screaming headlines about system failure. All China needs is a steady 19 to 20% premium over Western paper prices. While following Western price movements doesn't signal weakness, it signals control. Physical metal continues flowing east. Paper markets keep fighting themselves. Slow, sustained pressure beats fast explosions. This is like fishing. Reel in, let out, repeat. That's enough to quietly drain inventories, force Comex to raise margins, and allow paper markets to bleed out on their own. And speaking of Comex margin hikes, breaking news. Comex has just raised silver margins to roughly $52,000 per contract. That's over $10 per ounce, just to maintain a 5,000-ounce futures position. What does that mean? Traders either post more cash or get forced out. Leverage gets destroyed, weak hands are liquidated, paper liquidity dries up. Margin hikes don't happen in calm, healthy markets. They happen when volatility spikes and systemic risk rises. This impacts paper traders, not physical holders. While paper gets tighter, physical silver keeps moving, getting delivered and disappearing. Less leverage means fewer paper games and more stress where it actually matters, and that physical stress is undeniable. Another 5.6% of silver left Shanghai vaults in a single day. The drain continues at a rapid pace. Silver closed at 125.4 on the Shanghai Futures Exchange. Vaults are being drained even as paper prices collapse. Connect the dots. Here's the mid-video reveal that reframes everything. While the West panics over Kevin Worsh and dumps paper, look at what's happening on the physical side. The Shanghai premium expanded from $30 at $86 Comex to $44 at $78 Comex. Paper dropped $8 and the premium grew by $14. That is not panic selling in China, that is strategic accumulation. China is allowing the West to crash the paper price while quietly acquiring physical at scale. And this isn't limited to market participants. Governments are starting to wake up to the scarcity issue. The Czech foreign minister is traveling to the United States to discuss critical minerals. Silver isn't just an investment anymore. It's a critical material. And critical materials only become topics of diplomatic discussion when they're becoming scarce, not when they're abundant. When governments start framing supply chains as national security concerns, price charts stop mattering. Physical availability becomes the issue. Paper can be printed endlessly. Physical silver cannot. The Czech foreign minister's visit isn't coincidence, it's confirmation. Governments are recognizing that China controls the physical supply while the West continues playing paper games. We called 86 or lower if Trump didn't select Judy Shelton. He didn't. We hit 86 and then dropped to 78. While paper prices collapse, the physical market is tightening into a national security discussion. That's the disconnect stackers understand. Stackers aren't paranoid. They're early, and China's strategy is exceptionally effective. They don't need explosive moves. They don't need attention. They only need a consistent 19 to 20% premium that quietly drains Western vaults, forces margin hikes that crush paper liquidity, and positions them as the physical price setter when the paper market finally loses credibility. That's the war of exhaustion. That's the long game. And here's another critical data point. Producer price index inflation just came in hotter than expected. December PPI rose to 3% versus expectations of 2.7%. Core PPI jumped to 3.3% versus expectations of 2.9%. Core PPI is now at its highest level since July 2025. Inflation is accelerating, and yet silver was dumped, gold was dumped. Inflation hedges sold off on higher inflation data. Does that make sense? No, unless you understand that these markets are rigged, contrived, and fraudulent, where prices are set rather than discovered. For decades, the LBMA and Comex have demonstrated that they are incapable of operating free and fair markets. What we have witnessed over the past 24 hours is simply a continuation of those long-standing practices, only now the consequences are far more severe. And this manipulation doesn't stop with precious metals. The same distorted pricing mechanisms have left copper deeply undervalued as well, setting the stage for a massive shortage. Stocks, too, are heavily manipulated. In these systems, prices are dictated, not discovered. But consider this possibility. What if all of this is intentional? What if the real objective has been to wipe out smaller precious metals dealers by unleashing unmanageable volatility? What if the goal is to destabilize broader financial markets just enough to trigger consolidation, concentrating control into the hands of a few dominant players? You'll own nothing and be happy. Ever wonder how that outcome actually comes about? You're watching it unfold in real time through these artificial engineered markets. Now let AS address the bearish case, because we did hit 86 or lower exactly as predicted, and we're now sitting at 78. The technical damage is real. The 90 to 95 support zone failed. The 86 level broke. Selling pressure continued, driving price even lower. If this selling persists, additional downside is absolutely possible. Momentum remains bearish. The Fed chair appointment did not go to Judy Shelton, the sound money advocate many were hoping for. Instead, Trump selected Kevin Worsh. Worsh is openly anti-QE. Markets are now pricing tighter liquidity conditions, even if rates are reduced. That environment is hostile to leveraged assets. PPI inflation coming in hot. Doesn't matter if the balance sheet is being tightened. Under normal conditions, rising inflation would be bullish for gold and silver. But when liquidity is contracting, short-term price action can remain under pressure. Paper markets can stay irrational longer than most traders can remain solvent. If you are over-leveraged, if you're retrading on margin, this environment will destroy you. The Comex margin hikes are designed to flush out weak hands, and they are working. There's another risk worth acknowledging. If Kevin Worsh actually implements balance sheet reduction while cutting rates, we could see a prolonged period of tight liquidity. That would continue applying pressure across all asset classes, including precious metals. If the QE era truly ends, that marks a fundamental regime shift. Markets have not operated in a world without QE for over 15 years. Adjusting to that reality could be brutal and lengthy. But here's why the bearish case for paper does not invalidate the bullish case for physical metal. Reality is catching up fast, and real assets now have alternatives. China has emerged as the venue where true physical silver price discovery is taking place. That means the fraudulent paper pricing mechanisms in New York and London are becoming increasingly irrelevant. The massive spread between US paper prices and Chinese physical prices tells the entire story. That kind of divergence cannot persist in a functioning market. We are in the final phase of a severely mismanaged debt-based fiat system. The Czech Republic, sending ministers to the United States to discuss critical mineral supply chains, is not speculation, it is acknowledgement of scarcity. Shanghai vaults draining 5.6% in a single day. Only 14.6 million ounces left in SHFE inventories. Comex raising margins to $52,000 per contract. These are not signs of paper weakness, they are signals of physical stress. China's approach is working, a steady 19 to 20% premium. Quiet accumulation, forced margin hikes that choke Western paper liquidity. And when the paper system finally fractures, when the spread becomes so wide that arbitrage demands physical delivery at scale, China will already be positioned as the dominant physical holder and price setter. That is the end game. That's what stackers understand that traders often miss. So where does that leave us? 3 key takeaways, and we're almost done. First, the technical roadmap from the previous video played out perfectly. The 150-hour EMA initially provided support and delivered a 10% bounce. That level failed, sending price into the 90 to 95 zone. That support broke, taking silver straight to 86, exactly as projected. Selling continued, pushing price down to 78 as I'm recording this. The roadmap worked. If you're a short-term trader, these levels help you survive volatility. If you're a long-term stacker, this dip represents opportunity. Know which one you are. Second, Kevin Worsh as Fed chair, not Judy Shelton, means the battle isn't over, but the regime is changing. Worsh favors rate cuts paired with balance sheet reduction, not unlimited QE. Markets are beginning to price the end of the liquidity era. That it's bearish for paper in the short term, but it strengthens the long-term case for sound money and hard assets. If QE truly ends, fiat debasement may slow, but trust in paper continues to erode. Physical assets win either way. Third, China's war of exhaustion is succeeding. The Shanghai premium has now surged past 56%, sitting at roughly $44 per ounce. Vaults drained by 5.6% in a single day. Comex was forced to raise margins to $52,000 per contract. Czech officials are traveling to discuss critical mineral supply chains. This is no longer about daily price movement. It is about physical availability becoming a national security concern. Paper silver can be created endlessly. Physical silver cannot. China understands this. Stackers understand this. Paper traders are about to learn it the hard way. The unresolved question is simple. We hit 86 exactly as projected, then dropped to 78. Does this level stabilize? Or do we see one more flush lower before physical reality finally overwhelms paper manipulation? As China continues draining vaults at nearly 6% per day and the premium remains near 56%, how long before Western inventories reach critical levels and force a structural pricing shift? I said we'd hit 86 or lower if Trump didn't choose Judy Shelton and went with another candidate. He didn't, and we hit 86. Now we're at 78 and the premium has exploded to 56%. The technical levels are unfolding exactly as outlined. The physical fundamentals are screaming scarcity. The policy environment is shifting away from unlimited QE. And China is quietly winning a war of exhaustion while the West argues over paper prices. This is the disconnect. This is the opportunity. This is the moment where you decide whether you're stacking physical reality or trading paper fiction. Do your own research. Understand the risks. If you're trading with leverage, this volatility is a meat grinder. If you're stacking physical with a long-term perspective, this kind of shakeout creates generational buying opportunities. Time will reveal who understood the game. Invest with logic, not hype. OG out.